So thanks along for coming along to our Dig into Hedge Funds event with our two guest speakers, Michael Lee and Kevin Zhang. So I'm sure they're looking forward to sharing their words of wisdom with you guys over the next hour or so, and I'm sure that we're all looking forward to learning about it. So before we get into the event, as ACE, as a society, we aim to shed light onto the underrepresented areas of finance, such as private equity, venture capital, and hedge funds. And we have a variety of case competitions and educational events such as these that we're running today. And we hope that if you guys are interested in learning about them in the future, that you look at our Facebook page to look at events that we'll have coming up later on in the year. In terms of the agenda for today, we'll just briefly get Michael and Kevin to introduce themselves. They'll give an overview of the hedge fund industry, like what exactly are hedge funds, common strategy used in different asset classes, as well as having a quick look at the day in the life of what they do on a day-to-day basis. And it'll be wrapped up by a Q&A section at the end. I will send a Slido link in the chat for you guys to send through your questions as you think of them throughout the session. But without any further ado, I'll hand over to Michael and Kevin to get their presentation started. Thank you.
Thanks so much. Thanks AISOC for having me and Kevin on to talk about a bit about hedge funds. Certainly, it's definitely a topic that I think quite a lot of people have question marks about. It's great to be back with Kevin again, just because I know him from a former life in UNSW when we used to do case comps together. But I'll just kind of run you guys through the next few slides. As just mentioned, we'll talk a bit about the overview of the hedge fund industry and talk a bit about the day in our lives for each of us. So yeah, just in terms of speaker bio, very quickly, for those who don't know me, my name is Michael, and I'm an investment analyst at Antipodes Partners, and as an investment analyst, I cover European and North American software, internet, and media companies. Antipodes is a global equity hedge fund, investing about nearly $10 billion in funds under management for both retail and wholesale clients, and we have a pragmatic value focus when it comes to picking stocks both on the long and short side. So we can make money from share prices rising and falling. But the word hedge also comes from the fact that we can hedge currency and tail risk events using derivative instruments like put options and call options. So that's kind of what I do currently, and kind of in a former life, I was a cadet at Deloitte, and kind of worked my way up as an intern in different fund management firms, and was a past leader in UNSW for accounting, and also currently recently at the moment I'm also a happy investor in Sydney Science College, which is Sydney's first private STEM high school. So that's a private equity play, but yeah, I have a bit of experience over there. I think in terms of how I'm affiliated with UNSW, used to study commerce, majored in accounting and finance. Though currently now I'm studying for my CFA Level 3 exam, continuing my education there. And I'd just like to give a special mention to my mentors, Joey Mew and Albert Hong. I'll pass it on to Kevin.
Yeah, so thanks for having us on here. So hopefully we can shed some light on the hedge fund industry. I know it's something that's a bit opaque and something that's not really covered too much during university. So feel free to just pop your questions, and hopefully if Mike or I can answer them, we can do that in the Q&A session after. But yeah, just a bit about myself. So I've been working at Blue Lake Partners over the past year, and we're essentially a privately funded hedge fund or a family office. So most of our funds are sourced from our principals or our partners, and a lot of my trading is based about quantitative statistics. So a lot of regression modeling, or a lot of econometrics, if you've studied that in university. So looking at T tests, F scores, all that. So Michael and I both went to UNSW, and I studied commerce and eco for 4 years over there. And I'll probably go over my day-to-day life and what I do as a quant trader later in the slides, but I'll let Michael start us off.
Thanks, Kevin. Just talking a bit about, to kind of give our color on what the hedge fund industry looks like, I think it's helpful just to kind of talk a bit about, first off, the reason for being, why do we even have hedge funds in the first place? And, Kevin, feel free to chime in whenever you want. Why do hedge funds even exist in the first place? I think about it like a mathematical formula. If anyone's ever studied functions, there's an input, there's a function, which is a process, and then there's an output. Only in this case, the input is money, which goes into a function, which is a hedge fund that hopefully wisely, allocates money to wise investments that will produce an output, which is more money. So input, process, output. Hedge funds sit in the process. It also is helpful to remember, if you've studied finance, that every investment is a function of its future cash flows that it can generate, discounted back by an appropriate discount rate. When you're picking wise investments as a hedge fund or trades, in fact, each investment is a function of the future cash flows discounted back. So that's kind of what we try to do. Take some money, like $1, and make it into $2. That's the reason for being. So what are hedge funds? Hedge funds are a type of alternative assets. There's lots of different types of asset classes of investments that you can make. Whether that's leaving it in cash in a savings account, buying public equities, on Robinhood or ComSec, or the bit more sophisticated is putting money into real estate assets like buying a house, or other alternative assets like leaving your money with a fund manager in a hedge fund. So it is a type of alternative asset class. People with money who want to invest in a certain strategy will go to a hedge fund to express that view to make more money. Hedge funds can invest in a lot of different things. It could be invested in equities, bonds, real estate, a combination of all three or more. But really, people leave money to a fund manager in a hedge fund to, invest in a certain way or trade in a certain way. And there's a lot of different strategies and a lot of different kinds of exposures that people can get, whether that's just equities, bonds, or real estate, or whatever. There's a very simplistic answer for what is a hedge fund. It's really a postmodernist term, which is, it's whatever you want it to be. Although that's probably doesn't do it justice, but it can be a lot of different things. So maybe to take a step back even further in history, where did the word hedge fund even come from? I'm not going to make this into a history lesson because I'm not a historian, but I just want to point out a few key things that made the hedge fund industry possible. So if you take a step back to the 1940s, you'll see in the slide that there's a regulation of US funds, which began with the passage of the Investment Company Act of 1940. So that was a legislation that was instituted by US government to allow hedge funds to really start off. And there was a man called Alfred Winslow who started the first kind of hedge fund, and he defined it as such in the newspapers back in 1949. And the main idea of that hedge fund at the time was to protect investors' money from downside risk. So when share markets were falling, the hedge fund's purpose of Alfred Winslow's was to ensure that you didn't, if the market was down to 10%, you weren't down 10, you only maybe down 5 or 4 or 3, 2 or 0. So that was the original purpose of a hedge fund. And I guess, from there, I'll zoom out to 2012, where the US had the Jobs Act, which was passed, which basically allowed hedge funds to market themselves more to a broader audience. So now a lot more retail investors know about. So when I say retail, like mums and dads in the street, know about hedge funds and have more capabilities to leave their money with a hedge fund rather than just pick stocks themselves. So that's a bit about the history of hedge funds. Very quickly, when it comes to who can invest and what are popular strategies in hedge funds, there's this, I think maybe quickly, I'll just talk about, some of the most recent data we have. In 2020, total assets under management or money under management that's managed by hedge funds globally is about $3.8 trillion. So it's quite a big amount of money. And that's grown 16% per annum since 1997. So for the last 23 years, call it. And in terms of that money and where it's coming from, the people who are investing it are people like endowment funds, family offices, which is probably where Kevin falls in, fire, police, and teacher pension funds, super funds, individual investors, etc. And when you think about hedge fund strategies, like I said, people will leave their money with a hedge fund to express a certain view about how they want their money to be managed. There are different ways that it can be managed and different strategies. In this kind of little table from Analyzing Alpha, it shows long short equities are predominantly what most hedge fund strategies are, which is what Antipodes does. But then there are other strategies like emerging markets, global macro, fixed income, event-driven, etc. There's a whole lot of different strategies. It's very postmodernist. So that gives you a bit of flavor as to the different types of strategies that hedge funds can employ. So where does Antipodes Partners fit as a long-term hedge fund? In practice, like I said, Antipodes, where I work, manages about $9 to $10 billion in funds under management. And like I said, I guess the word hedge really comes from this idea of being able to use derivatives, different instruments like futures, forwards, options, and swaps to hedge tail and currency risk events. And this business was founded by Jacob Mitchell in 2015. That's a plug I have to put in. But basically, when it comes to like tail and currency risk events, for example, knowing that market, for example, for a tail risk event like COVID last year, when equity markets sold off 35% in March 2020, it would have been nice if you had some insurance, to protect you on the downside. And for Antipodes Partners, we had equity put options on the equity indexes in the US. So when those fell, we were able to benefit even on the downside. So that's kind of one way that we can hedge certain downside market risk is by having for example put options. We have the capability to do that. We have a goal of delivering above market returns at below market levels of risk over a 3 to 5 year period. The money that comes into us to make up that $9 billion is kind of a 50-50 split between retail money like mums and dads, but then there's also wholesale money, which is institutional, like pension funds, teacher funds, etc. I think to say, in terms of the way, we invest, which can be long and short, different public equities, we're unconstrained by the index. We don't have to follow whatever benchmark index there is, like the MSCI World Index. We can pick stocks, but how we do it is we pick stocks based on starting valuation, business resilience, and then managing the portfolio risk using derivatives. So, for us as a long-term hedge fund, our investment universe is really about 4,000 global companies across the world that we look through, whether it's a long or short. And we run it through our process of thinking about starting valuation, business resilience, and managing portfolio risk to build 3 different kinds of investment funds that hopefully delivers above market returns at below market levels of risk. So that's the Antipodes Global Fund, long only and long short, and also the Antipodes Asia Fund. So that's a bit about Antipodes Partners and where it fits in as a hedge fund. Feel free to ask me any questions if I'm not clear on anything, but I'll pass it on to Kevin.
Yep, thanks. So pretty much most of the slides that we're talking about here is focused on equities, but the hedge fund industry is very large. So you can manage a whole lot of different asset classes. So equity is probably the one that's most thrown about, the one that you probably hear about the most at university. You probably also heard about fixed income or bonds if you've also studied that at university. So you'd be looking at different interest rates along the curve and pretty much taking like a directional bet along there. So it's more macro based versus equities. And then, yeah, as Michael talked about earlier, you can go into a whole lot of different derivatives. So you can be doing put options or call options, and you can also be looking at real estate as well. And recently as well, there's also been a lot of different alternative asset classes as well. So you've got hedge funds that have focused purely on crypto. So one of the best performing hedge funds over the past year or so was Apollo Capital. So they're a crypto hedge fund based in Melbourne. And they do all sorts of different strategies. So they do like staking as well as just general long positions in different altcoins and different coins within the sector. So for those who are interested in the hedge fund industry or do want to pursue a career in hedge funds in the future, definitely try to figure out what sort of asset class suits you, because every different asset class has its own set of different skills and its own set of niches. So one person who might really be interested in equity might not be as good as a fixed income trader, or one person who's really interested in crypto might lean towards a fund that focuses purely on crypto versus one that does like equity or fixed income. And yeah, there's also a recent article on Bloomberg as well about a hedge fund who also had a great year just doing bets along horse racing in Hong Kong. So definitely check that out if you're interested in that. We'll move to the next slide. Yeah, so in terms of getting experience or pursuing a career in a hedge fund, for speaking my own experience, how I managed to get an interest into this sort of space was purely doing a bit of equity trading for myself. So for me, just setting up my own ComSec account, doing a few trades here and there, and then doing case competitions, and also just doing internships as well. So that's, I guess, your best bet in terms of getting into the space, because it's not a very it's not as heavily marketed, and it's not as heavily marketed as other positions in finance, such as like banking or corporate finance. And typically what you'll see is in Australia, a lot of the hedge funds that do operate in Australia also have a large focus across other equities. So if you are investing in the market, definitely take a look at the US or Asian equity markets as well, because what you'll see is that if you do join a hedge fund in Australia, because the market in Australia isn't as big as those offshore, you'll also be focusing a lot on other markets as well, such as Antipodes. So Antipodes have funds not only based on Australian stocks, but also funds based in Asia or in the US as well. So we'll just move on to the next slide, or Q&A. Oh, yeah.
Day in the life. Yeah, no, thanks, Kev. I think, I think that's a bit about the hedge fund industry in general, the macro level. I guess if you want to be a bit more micro and kind of give you a bit of a flavor as to what we do, every day, this is, I guess, an example of what a busy day might look like at Antipodes, which at least hopefully reads a bit more excitingly than my off days. It's almost nothing like Wall Street, so Wolf of Wall Street. So if any of you guys have watched that, it's almost furthest from the truth. Maybe a bit more like the Big Short, if anyone's watched that. But even then, it's less glamorous and less exciting, to be honest, most of the time. So what does the day look like? For me, a busy day could look like waking up at around 7:45, 7:50 a.m., brushing my teeth, and then by 8 a.m. There may be, as in this current period, reporting seasons for different companies publicly. Maybe there's a company in the US that's reported in the evening, which means it's our morning time in Australia. So at 8 a.m. I might be reading a second quarter company press release on the latest numbers and listening to the earnings call. So that will probably be work that I'll do, taking some notes there. And then, by 8:45 a.m., generally what I do is I'll look over my emails and other news sources like AFR or Wall Street Journal to pick up any other news that is relevant to any of the equity positions that we hold in the fund, particularly under my coverage, because I cover software companies. So, if there's anything happening to Google or Facebook or Microsoft that's material, then I might write that down. And, by 9 a.m., we have a daily meeting. I might talk about it. So after that, by then, 9:30 to 12:30 is really what I like to think is generally fast thinking work, where, I'm basically plugging in the latest numbers from the company's press release from the company earlier at 8 a.m. that I'm talking about, and writing an update on the latest results, and then talking about whether we should buy, hold, or sell it. In most of the cases, I find that generally we don't really change too much in our position Generally, it's kind of just a hold in most cases. But if there's something materially wrong, then maybe we'll trim the position. Or if, maybe there's nothing wrong with the business and it's just sold off, then maybe we might add to it. 12:30 p.m. for lunch, because I'm not crazy. I still need to eat. And 1 p.m. to let's call it 6:30 p.m. to dinner is really more slower thinking work, where along the way we're not just looking at companies, but we may be exploring new industries. So for me at the moment, I've been doing a lot of work on the ad tech space. So the advertising technology value chain is actually a very complicated network of businesses. It's not just Google and Facebook. There's a lot of small players where you can go to buy and sell ads. And I've been doing a lot of industry work there, and I might also find opportunities to speak to different experts in the industry on call. And so that's what I'll do. Usually right before dinner, I often review the portfolio holdings in our fund under my coverage one more time to see if there's anything important to think about for the next day. And that's basically it in terms of slow thinking work. Having dinner and then do the rest of the stuff like resting because I'm not an animal. I have to rest, and outside work activities, which is either gaming or studying for CFA exam. But actually, before I sleep, usually around 12 or 1 a.m., I do go over my emails and I look at the European US markets, because that's usually at the time when they start to open, and I kind of want to see how the market's tracking before I sleep. So already you can tell that you really have to have a kind of incessant passion for markets and being interested in news to be able to religiously do stuff like this on a regular day-to-day basis. So it's definitely not everyone's cup of tea, but if this is the kind of like busy day that you'd like to expect, then perhaps this is right for you. So I'll pass it back to Kevin.
Thanks. Yeah, so I'll give a bit more context as to what I do, or what my sort of strategies revolve around, and then I'll go into my day at Blue Lake. So pretty much for me, I focus mainly on, so for those who don't know, it closes at 4 p.m. And a lot of the strategies that I run are based on events. So events that occur regularly. So you might have like IPOs, capital raisings, earnings, or mergers and acquisitions. And in my line of work as a quant trader, we don't have as much of a focus on fundamentals, but more of a focus on statistics. So typically we're looking at price movements or any news that might act as callous that could affect the share price, since we're going in and out of the stock and holding stocks for maybe like a day or a week or even like a month. So for myself, I typically don't hold stocks for too long. And even though I do have a certain understanding of the fundamentals of companies, I don't go into a deep dive into where I think the fair value of a company should be, or really hold a stock beyond like a year or a couple of years. So just as an example, what I might look at as a quant is a repetitive event, like for example, looking at iron ore prices and looking at how it affects the prices of, or the share prices of Rio and Tinto. So typically a lot of my time during the day is spent modeling any particular strategy that I think can make money. So I could observe one particular event in the market, such as like iron ore opening up 5% in the morning, and then tracking how that affects iron ore miners like BHP and Fortescue. So typically what you expect is with these miners, if their commodity price goes up by 1 or 2%, you'd also expect their stock price to go up by a certain amount as well. So for example, I could do a back test, so I can look at a lot of different statistics over the past 5 to 10 years. So every time the iron ore prices moved up, for example, 5% over the past 24 hours, how much do the stock prices move for BHP, Fortescue, and Rio? So I might look at the past 10,000 examples of when iron ore was up 5% or when iron ore was down 5%, and then also find the average of where BHP and Fortescue and Rio closed. So there might be a one-to-one correlation if we run the stats. I haven't tested it, but for example, if you do see a Rio, Fortescue, and BHP also close 5% when iron ore is up 5%, then you can sort of create a strategy around that where in the future, if iron ore is up 5% and perhaps Rio is up 6%, Fortescue is up 4%, then you could short BHP and then go long Rio, since on average, you expect two companies to be up 5% when iron ore is up 5% as well. So it's not really that simple in reality when you do trade it, but typically what you'll do as a quant trader is you have to have a lot of faith in your statistics. So you'll make a lot of trades over the course of a year, and then on average, you'll hopefully make money if your strategies are statistically significant or do make sense. So yeah, I'll just go through the typical day that I have. So generally for me, it's a lot more busier when companies do have a lot of events. So generally February and August are the busiest 2 months of the year for me, because those are the 2 reporting seasons in the ASX. So every company that wants to remain listed on the ASX has to give their half yearly and their yearly earnings across the 2 months. So you generally get a lot of the volatility around those 2 periods. So typically, yeah, I get in quite early. So on busier periods between 7:30 to 8, but typically around 8 for normal times. And then, yeah, I usually check up on all the news that any relevant news like earnings, IPOs, mergers and arbs, or any typical or any events that are covered under my models. And I'll also look at overnight leads as well. So looking at how the US market's gone or how the European market's gone as well, because typically what happens to sectors over there generally has a flow-on effect to our sectors as well. And then, yeah, between 9 to 10, I'll be looking at my Excel models as well as going through Bloomberg, seeing if there's any news that pops up between 9 to 10. So typically what you'll see is in the ASX, all of the announcements do get released right before the open. So between 9 to 10, you might have a particular strategy that you want to take on, but then that company might announce news. So then you'll have to revise your models as well. So typically between 9 to 10, I'm looking at my models as well as keeping an eye on any sort of news that comes out or comes from the ASX. And then 10 to 10:30 is generally the most hectic period of my day. So that's when you get the most volatility, and also a lot of volume. So then you have a staggered open in Australia where the A's and B's open first, and then you get the next couple of letters, so C, D's, and E's, and that typically happens between 10 to 10:10. And generally, I'm just keeping an eye on all my algorithms and my models and just making sure that nothing's going wrong. And then it typically quiets down for me between 10:30 to around the close. So between 10:30 to 12, I'm just monitoring the models, looking at the market, scanning any movements that are particularly odd. And I'll also be doing a lot of reading as well. So just catching up on the news, seeing any sort of announcements that have been made after the open. And between 12 to 3, I'll typically be working on my own thing. So that could just be doing some light reading or doing some researching and back testing. So if I notice anything in the market that's quite odd, or that could potentially make money, then I can also test that as well. So I can build some models or look at historical events to see how that's shaped in the past. And then if it looks like it could create profits in the future, then I can create a model around that and try to back test and forward test that in the future. And so typically between 3 to 4, that's when the market's about to close. So I'll put my algorithms in and I'll also monitor the market close. And then typically after that, I'll just review my day and look at my positions. And typically I won't do anything past 5. So once the markets are closed in Australia, there's no aftermarket like there is in the US. So there's really nothing else that you can do once the day's over. Yeah, with that, we'll just pass it on to Q&A.
Thanks, Kim. Yeah, I think that's basically a wrap on, I guess, the overview of the hedge fund industry, and I guess a bit of a taste of what a day in the life looks like, for me and Kevin. Certainly quite different, but in a lot of ways, I think, there's a lot of ways you can make money in the market. I think that's a big lesson to take away from this. And there's a lot of different strategies out there. And it's really, I think, for prospective students on this call who may be interested in thinking about this as a career, is to think about, like what kind of strategy do you think you resonate with, and then focusing your efforts there and being the best you can be. because there are lots of ways to make money. It's not to say that my way or Kevin's way is the right way or wrong way. There are lots of different ways, and that's why there's a lot of different hedge funds to express different strategy views. So with that, yeah, I think we're happy to take Q&A.
Yeah, I've collated some questions that people have sent in. So the first one is, what are the regulations that can be imposed by the hedge fund you work for that can impact your personal trades or investments?
I'll start. For Antipodes, we have a back office, which is where compliance sits, and that's run by Pinnacle Investment Management. They don't manage funds, but they're like a fund of funds. They provide all the back office to different fund managers like Antipodes, and yeah, kind of their policies in place, restrict us from trading a stock that Antipodes is involved in. I think with at least has to be outside 10 days of for example, if Antipodes bought Facebook, then the next 10 days I can't buy Facebook. At least at a minimum, and also yeah, you still have to get your approval from the chief investment officer, and they have to sign off to allow you to make a trade, whether that's a buy or a sell. So yeah, that's the kind of regulation in place for Antipodes.
Yeah, for myself, yeah, as you'll see with the hedge fund industry, there's typically less regulations than you would have if you were working on the sell side. Just because at hedge funds, you're not really working on deals. So if you do work in the sell side, you'll see that you'll have a lot of restrictions, like you'll have 30-day windows and a lot of Chinese walls. So if there's a particular transaction that one part of the bank's working on, then you can't do any particular trades in that. Whereas for hedge funds, typically what you'll see is that, yeah, as Michael said, you just can't trade the stocks that you're trading at work. So for myself, there's a few, there's a lot less restrictions than what we would have in the sell side, just because one, we're a hedge fund, and then also as a family office, we're not taking outside money. So for me, I typically have, I can't do any sort of intraday trading, and I can't trade any of the stocks that my firm is also trading.
Great, thank you. Now we've got a question specifically for Kevin. It's what's your level of technical skills that you need to be a quantitative trader? And do you have any statistical approaches to risk management, such as figuring out good places for a stop or loss?
Yeah, that's a good question. So for myself, when I first entered the industry, I didn't really have a strong coding background or really any experience at all. So I did like an internship in my second year of university at my fund before I started working full time after I graduated. So fortunately for me, I learned most of my skills on the job. So on a day-to-day basis, I use Bloomberg quite a bit, and I also use Excel. So Bloomberg have their own really great API. So if you don't know how to do any sort of coding, they have their own language, which probably takes about like half a year or to a year to get fluent in. But yeah, definitely a lot of firms nowadays are looking at having hard or technical skills, like learn how to code and how to use particular packages like Python or C. But as a quant trader, what you will see as well is a lot of these hedge funds also hire separately. So they'll hire traders and they'll also hire software developers as well. So you don't have to go into the industry thinking that you do need to know how to do coding, and you do have to have a strong background in computer science or engineering, because there are people who have that skill set and who work in that particular role. But it always is good to have some sort of experience or knowledge. So then you can also talk to your developers and tell them what sort of strategy you want to create, and also have a general understanding of whether or not it's feasible. But yeah, I think in general, you probably want to have like Excel skills, because across the industry, you'll be creating models regardless of what sort of type of fund you're part of. But yeah, hopefully that answers this question. So yeah, just Excel skills, and if you have time, maybe a bit of coding skills as well.
Great, thank you. The third question we have is, what lifespan do you find your strategies have within the market before they are no longer profitable or feasible?
Yep. I'll go first. So for me, it's probably a lot shorter than what Michael does. So because for me, a lot of my strategies come and go with the market. So they're based on particular anomalies that I might notice and anomalies that can fade over time. So it really depends on the sort of strategy that I'm running. Like if I'm doing like a momentum strategy, or if I'm doing tracking commodity prices or so. Like with momentum strategies, they can come and go depending on how well the market's going. So during bad times, like during COVID, you might see a lot of money flow out of the market. It'll be hard running some sort of long only momentum strategy. And it really depends on the strategy itself. So sometimes a strategy can work for about a couple of months before it stops working, or it could be even a couple of years. So as a quant trader, it's quite difficult to tell whether or not you think a strategy is working, or whether or not there's not enough of a sample size because you're taking so many trades over a particular time period. But it really depends on the sort of strategy you're running. So if you're doing like a quant strategy or an event-based strategy, it might be a lot shorter than what you would be doing if you're just doing like a long short portfolio, or if you were doing fundamental analysis.
Yeah, I'll step in. I guess in terms of the duration or the longevity of a strategy, to be clear, I think like activity is first and foremost a fundamental shop. So we look at financials, we understand businesses and industries, and try to invest in businesses and industries that will do well over the next 3 to 5 years. So there is I guess when you think about the best example of an investor like that, I think I always just point to Warren Buffett, right? I mean, when you look at Warren Buffett and his investment strategy of buying high quality companies run by good management teams that deliver return on capital over time, I think for me, I find myself kind of falling under that same view of believing if you understand that if you can understand a company is going to do well, then ideally the share price will do well in the long run. That's been a working strategy I've seen from Warren Buffett, who's been doing this for decades. But certainly the market is dynamic. It's not a one-way street. The market can evolve and favor certain things and be out of favor on other things. And that can that could question your own strategy. But I tend to think that when it comes to fundamental investing, my view in all of this is, it comes back to the reason of being, like I said, that every investment, if you see things as an investment and not a trade, which is different, I can understand. But if you think about things as an investor, then every asset has a value that's worth the future cash flows it generates, discounted back by a discount rate. So, if you believe that, then as reason for being, then picking companies is about finding those companies that will continue to generate higher and higher free cash flows and can compound those free cash flows over time, and ideally it'll be worth more in the future. I think for me, my edge is less in like trying to time entry and exit points in the short term over a 1 day, but it's more about understanding where industries and companies are going over the next 3 to 5 years that some people don't have the patience for. So I guess I think it is the strategy of patience and picking long-term winners is a working strategy, as has been proven time and time again for the last few decades. So I think there is longevity in the strategy.
Brilliant. Thanks, guys. For Kevin again, just if you could briefly touch upon if you have any statistical approaches to risk management and figuring out good places for the stop loss.
Yeah, so with regards to that, sorry I didn't address that earlier, but these are stop losses and profit takes are things that you can test statistically as well. So just going back to that example of commodities, so you can do the back test, or you can look at the historical. There's a lot of different sources where you can get your data from. So if you can get it from Bloomberg, Reuters, I think even Yahoo Finance has historical data as well, which goes back decades, and they can give you different price points as well, like high prices, low prices, open prices, closed prices. So as an example, if you wanted to look at like iron ore prices, or if we can even look at like crypto as well, right? You can see for every time Bitcoin goes up 10% in the past 24 hours, how often or not does Ethereum go up by 5 to 15%. So you can look at the past 10,000 cases or whatever kind of cases that Bitcoin goes up more than 10% in the past, or goes down 10%, and you can see how much Ethereum goes up by or down over the same time period. So then you can get like a general correlation and then trade based on that. So then you can look in real time and see if Bitcoin's up like 10% and the correlation's 1, and if Ethereum is not trading up 10%, then you'll buy Ethereum. And then you can also do stop losses as well. So you can use Excel, and you can use whatever data source you are. Whatever data source you're using to back test or statistically test. So you can do one without a stop loss. You can literally do a strategy where Bitcoin's up 10%, you go long Ethereum if it's less than 10%, and then you hold it for a day. Or you can hold it for 2 days, 10 days, 1 week, 1 month, depending on what sort of strategy you're looking for. And then you can look at the average of all the returns that you get from holding Ethereum after Bitcoin's gone up 10% or so. And then you can also look at the high and the low prices as well to see whether or not stop losses actually add value to your strategy. So looking at like the high price and the low price, you can see that you can check whether or not you would have been stopped out. So for example, if Bitcoin's gone up 10% and then Ethereum's only gone up 5%, then the strategy would tell you to go long. But then you can see that later during the day, it hit a low price of minus 5% Ethereum, so it swung down. So then you would have been stopped out at like whatever your stop loss is, whether it's 0%, -2. And then for that particular sell, for that particular event, you just record like a loss of -2%. And then you can just repeat the exact same formula or this exact same algorithm for all your other historical trades. And then you can look at what sort of results that particular strategy with a stop loss creates versus one without a stop loss. So typically whenever you're doing or you're testing a strategy for the first time, you want to test a lot of different parameters. So you can test how the strategy might work if you're holding it for 1 day, 2 days, 5 days, 10 days, 10 months. And then you can also test what sort of returns you'll be getting if you use different stop losses, like a 1% stop loss, a 2% stop loss. And then based on that, or based on the different averages and the standard deviations and the T tests and the F scores that you get, you can pretty much determine what the highest Sharpe ratio is, so the most return for the least amount of risk. And then you can forward test that as well. So you might see that sometimes the stop loss might not work, because what happens is you might see Bitcoin up 5% and Ethereum only up 5%. But then when you buy Ethereum, it dips down to 0% and then goes up 20%. So then in that case, you'll get stopped out at 0% if you had a stop at 0, and you lose 5% because it goes up 5% and then it comes down and then goes back up 20%, versus just not having a stop loss. So it's all things you can really test on your own, and by just getting the statistics and just testing like your returns, and also doing risk adjusted returns, whether it's Sharpe ratios or just looking at your drawdown or any other particular statistics. So hopefully that answers your question.
Brilliant. Thanks, Kevin. It looks like, it did answer that question very well. And just a final couple of questions. It's, what's your view on the quantitative versus discretionary investment approaches?
So what do you mean by discretionary investment approach?
I think it means like quantitative versus if like the portfolio manager makes the decision. I think that's what they're looking at.
Okay, yeah. I'll just start on this. So as Michael said earlier, there's a lot of different ways to earn money in the market. So Michael's investment strategy would be more discretionary, since he is taking a look into a company, he's generating his own thesis, and then he's discretionarily buying or shorting that stock and holding it for a discretionary amount of time, depending on if there's an event, whether it's played out to his thesis and catalysts. Whereas
it's not
for
always
me,
3 to 5 years. I can also do quick trades too.
Yeah, exactly.
I dabble in dark arts.
Yeah. Whereas for me, a lot of, hopefully by now you realize that for me, a lot of my trades are more quantitative. So I don't really care. I don't really look too much into the fundamentals of a company when I buy it. I'll have strict guidelines, like my strategy says, get out at a 2% stop loss, a minus 2% stop loss, or hold it for 1 day, or hold it for 2 days, or hold it for 2 months. So yeah, just going back to the same point, it really depends on yeah, there's a lot of different ways to make money in this market, and it just depends on your investment style that you're comfortable with. So for me, one of the things I like about quantitative trading is that it really removes a lot of your emotion. So regardless if you're winning money or if you're losing, at the end of the day, if your strategy says cut it by 5 days, then you have to cut it. So you pretty much just, yeah, you have no sort of discretion, whatever, no sort of emotions in play, and you just execute it accordingly to your statistics. And if your statistics do make sense, then, or if your model is accurate, then yeah, you just follow the trades and then hopefully make money over the long run. But yeah, it's a very different style of investing than compared to what Michael does. So Michael really gets to understand the company, the founders, and yeah, you really need to have like a really deep knowledge of the company and all those potential catalysts that come up in the future. So yeah, at the end of the day, it just depends on your sort of skill set. If you like looking at statistics, you like doing a lot more modeling, you like looking at yeah, like catalysts or events, then yeah, take a look into quant trading. Whereas if you're more about, you know, looking at a thesis, the valuation, trying to understand the company and its long-term and yeah, where it's going in the long term, or it's like, then that's probably more fundamental. Yeah, that's probably, you're leaning more towards the fundamental side of things.
Yeah, I think I'll just add on that. No, that was good, Kevin. That's good, Kevin. I think yeah, like certainly no, maybe the case for those who may be interested more on the fundamental side about reading financials and speaking to competitors and speaking to company management. That's all the kind of stuff that I do that I don't think Kevin probably does. But yeah, it's a preference thing, right? Of finding, I think, what strategy you're most comfortable with and executing, and hopefully you'll make money on that said strategy. Yeah, it's different, but I think it boils down to, for students, I think, to figure out what they're comfortable with, and you know, and what works for you, to figure out what style is best. I don't think there's anyone who can tell you what's the best strategy except yourself. But yeah, I think like but I do believe in this idea of backtesting, where certainly everybody who is in the market wisely should be having a process in place, whether that's a process like Kevin or a process like mine. You know, we all also should be backtesting it and rigorously checking whether our process of picking investments or trades is right or wrong. You know, you can't hide away from that. Everyone should do that in our industry, and continually refining the process is, I think, honestly, like, I think the most fun part of this job is, you know, is you always learn from the market, and it's a very humbling teacher, and you'll find that there's always a new way to make money or lose money. And it's a never-ending process of learning. So, you know, I think that's really a case for, you know, more broadly about like why I think people should be considering this industry. And then, you know, trying to figure out what style works best for you is up to you. Yeah, thanks.
Great. And final question is, what types of work experiences or extracurriculars do you feel are expected by recruiters for hedge fund grads?
Yeah, I'll answer that first. At least from my point of view in applying for these different places, what I found is, you know, my advice is always to students to apply to, or figure out first and foremost whether you have a passion for this industry. And let's assume that you do, then, and you know what strategy or style is your type of process of making money, then go for those firms. Speaking specifically for me, that was me then applying to like 40, 50 different, you know, fund managers across Sydney, sending them an email with my CV and a one-page stock note explaining why I think this was a great stock idea for the next 3 to 5 years. I think it was reject shopped, actually. Probably wasn't the best idea, but anyways, you know, that was kind of how I tried to apply to those shops, was showing that I could do fundamental research and think about how to value a company and do fundamental research of understanding the industry and strengths, weaknesses, opportunities, and threats of Reject Shop. Showing that in a one pager is actually better than any CV, in my opinion. And then I sent that to many different fund managers just to see if there was any opportunities to take me on as an intern. And really, that was actually how I got the interest originally of my mentor, who was the chairman of Australian Eagle Asset Management, and eventually took me on as an intern. So you never know when you send these things, but I do think like sending a sample of work that is relevant to the shop that you're applying for is the best way to get your foot in the door. The other strategy I tell people is to offer to work for free, obviously not to be exploited by that, but I think at least for the first 1 or 2 months, you could make the case that you're just trying to get your foot in the door, you're trying to learn, and you're willing to work for free for a short period of time in any capacity possible, even if that's just doing filing work or admin work at the fund, at least just to get your foot in the door and get experience. That's always a working strategy. Sometimes, I think fund managers can appreciate that and are willing to take you on. But yeah, you'll find that fund managers don't really promote themselves when it comes to job recruitments, which is something that I think we should be better at. Because yeah, it is a really exciting industry that I think can be benefited by really young people. But yeah, you really have to knock on a lot of doors, is what I would say, and send emails and send phone calls. And yeah, I think that's probably the advice I'd give for my end. Also getting involved in different societies like AISOC or Investing for Charity or Australian Student Asset Management Society is all really relevant. Finding university societies that do this kind of stuff to give you exposure or relations with people from the industry like me and Kevin, then these societies can also be really helpful. And I think actually, like, the way I got my foot in the door really at Antipodes was actually, a funny story was actually a competition that me and Kevin actually pitched in back in FMAA, incidentally, for a stock pitch competition on Crown Casino. And actually, the judge in the finals there was actually my current boss, so James Rodder, the PM, the portfolio manager. He actually found me from that stock pitch competition, and told me to kind of go interview, and that's how I ended up getting my grad job. So yeah, sometimes you never expect sometimes where you might find your job opportunity and where you find your passion. I think for me it was actually ironically in a competition that I did that almost begrudgingly at the beginning, to do with case competition with some friends in uni, and it turned out actually to be probably the best investment I made. So yeah, explore different case competitions if that's what interests you. Look at different universities, offer to work for free if that's possible, and cold call and cold email as much as you can, because our industry doesn't really promote as much. So that's what I would say to that.
Yeah, I think Michael summarized that perfectly. So yeah, unfortunately in Australia, there's not too much recruitment around hedge funds, especially at an intern or a graduate level. So I think Antipodes is probably one of the very few hedge funds out there that do actively recruit grads every year or so. And that just comes down to a function of our market. So in terms of how they typically recruit people, generally they look for people who have experience on the sell side, and then after a couple of years you can move over to a hedge fund. But there are a lot more hedge funds nowadays, like Antipodes, I think Platinum and Magellan also have internship and graduate opportunities as well. And yeah, as Michael said, like, definitely network around, do a lot of events, and especially from a recruiter's perspective, we all really like looking at students who have an interest in trading or investing. So it is a space that is very hard to fake it until you make it, because at the end of the day, you are going to pitch a stock, or you are going to pitch an idea at any sort of level, at an intern level or at a graduate level. So you really have to have a good sort of understanding and interest in stock markets or fixed income, whatever asset class you're interested in. So a good way to do that is just to, yeah, as Michael said, like, get involved in university, like AISOC, doing a lot of case competitions. And even if you have a bit of money or savings yourself, you can even test out the stock market yourself, put some money in stocks or ETFs, if you're uncomfortable with that, then you can even just set up a demo account, or even join like a trading competition. So I'm just going to shamelessly plug our competition here, One News. So we run a competition every year, which is a trading competition based on like the AISOC 300. So you can buy and sell stocks, and then simulate your portfolio, and it's just free of charge. So that's a good way of how we recruit for students or how we find talent. So yeah, just doing like the AISOC share market competition, doing our share market competition. As Michael said, doing like case competitions as well, really gets your foot in the door, gets you that experience. So if you do ever do an interview, you can talk about it, and you can also relate to it as well. Other than that, yeah, I think Mike was pretty much hit the nail on the head there. That's generally what hedge funds look for, and what you want to be doing as a university student.
Can I just say, Kevin, maybe just to add, like, yeah, certainly, I think, like, I'm pretty sure it's the same for even quant funds, but like, at least for like our fundamental type hedge funds, we care a lot about whether you love investing. It almost feels like, when someone loves investing, by the way you talk to them and you feel the aura. It's very difficult to describe, but I mean, at least from Antipodes' point of view, we care a lot about people who have their own personal portfolio and who are actually investing their own money. Because I always say, if you can't invest your own money, how can you invest other people's money? And you got to remember, right? Your job is one that is major responsibility and also privilege, and it's a duty where you're entrusted with a big amount of money, and you have to, make it into more money. Otherwise, what's the reason for being? So yeah, it is that's always the pushback I will give to students, is like who are thinking about this industry, is certainly recognize the importance and the responsibility of your role. If you're looking after other people's money, it's not something that you do for fun. As in, sometimes it is fun, but in most cases you have to take it very seriously. You don't like losing money, no one does. And yeah, it's one where, yeah, I think for us, we love to see if people have their own personal portfolio they can talk about, like their winners and losers, where they've made money, where they've lost money. Explain to us why you've made money or lost money on different stocks. That's always interesting to us, because I think our rule is that if the person doesn't have their own personal portfolio, we're not interested in interviewing the person. So that's kind of at least maybe a peek into Antipodes. We are quite judicious about that, but I think it's for the best, because we obviously want to screen for people who are very passionate about investing. But that's our 2 cents on kind of what Antipodes looks for in students. Yeah.
Great. Thanks for all your comprehensive answers to our questions and taking the time out of your busy schedule to give your presentation to us. I'm sure that we all gained a large amount of insights from both of you, and we appreciate you spending your time with us. So I think that about wraps up our event. So unless you guys have got any closing comments that you'd like to add, yeah, that about wraps it up for tonight. Thank you.
I think I'll just say, like, for those who may be interested, I do have a blog where I used to talk about my investment portfolio. So, for those who are interested, there's a Substack. It's called The Ordinary Investor, which is here. I don't know if you can see my screen, but yeah, this was the original blog where I used to talk about my investment portfolio, but I'll put it in the Zoom chat for those who may be interested. I can't really talk about investing now because of conflict of interest with compliance from Pinnacle, but in the past, you'll see that I used to talk a bit more about investing in the early days when I was a university student. So this could give you a flavor of, the kind of stuff that I was thinking about back as a university student, trying to figure out what I wanted to do for the rest of my life. But yeah, you could see, like, this is the kind of stuff that I used to do. And yeah, if it interests you, feel free to check out my blog for those that are interested. But yeah, thanks everyone for listening, and thanks AISOC for having us. That's kind of my final words for tonight. I don't know if Kevin has anything he wants to add.
Yeah, just follow any events that AISOC promote. Then yeah, if you have any questions about the hedge fund industry, just feel free to shoot for a message, and I'll try to answer them if I can.
Yep, find us on LinkedIn. Cool. Thanks, guys. Appreciate it.
Thank you.
All right, take care, guys.